Hi, welcome to Challenge JP. My name is Jacek, and today I'm going to show you how to create a financial model with debt calculations.
Okay, let's start with just the summary and a general structure of the model, and then we can go into detailed calculations. First of all, you will see that the model is structured in a way, so we show the years here on the top. Then we will show the forecast for the number of sales, which will drive the revenues, which then drive the cost of sales, gross margin, then some general Opex and salaries. This will get us to the EBITDA with some tax estimates. Beneath that, some R&D or other CapEx expenses, working capital, which will get us to unlevered cash flow. So this is the unlevered cash flow being the cash flow before any debt injections. And with that, we will then look into including the debt calculations into the model, namely the way you can estimate the level of debt that you can draw, also the principal repayments, so sort of the amortization profile of the debt, and then calculations of interest, any additional fees, and also tax adjustments in case if you can deduct your interest from your tax liabilities. This part of the model, that model will then lead us to calculation of levered cash flows, which is basically the cash flow including the debt. Okay, so that's going to be the sort of the core part of this tutorial. You see that this is the summary. On my right here, next to the summary, those are the main assumptions of the model, which you can easily change. So the model is quite flexible. For example, you can change any of this figure here, let's say the number of sales per month. That's something that we'll get back to after talking about the cash flow model and the debt model. That having the table with the assumptions next to the summary will make it easy to do a quick sensitivity analysis and stress test of the model itself. But again, as you see, the structure is quite simple. It's just the revenues followed by cost, any calculations of capex and tax, and then the debt on top of that, with the main assumptions to the right. Okay, so let's go to the cash flow calculations. As you will see, I model everything on a monthly basis because that just makes it easy then to aggregate into either annual view, which you saw on the previous page, or quarterly view, or however you want to present your model in the future. So just having this monthly view is very useful for that. And as I mentioned just at the very beginning, I'm starting with some main assumptions here. Those would be, for example, the date at which you want to start your model. In our case, that's January 2003, for example, but you can obviously change that in the assumption page. You will see that if you click on, let's say that January 23, or if you click on any of the numbers to the left of the model, all of those links go back to that summary page. So they basically link, any of this assumption is linked to the table of the assumptions here, with the idea being that you will change the assumptions in this page, in the summary page, and then that is then linked to the calculation page of your cash flow, so you can see exactly what sort of assumption is being applied, what assumption is being applied to the model itself. Okay, all right. So let's very quickly go through it. The model starts with the number of sales. So just assuming that you have a business that makes monthly sales. The idea is that you want to have the driver of your revenues and some of your direct cost on top of the model itself. Okay, so for simplicity, I just assume that, let's say you start with 1,250 sales per month, and then I added monthly sales growth on top of that, right? So you see that 1,250 increases by that 10%, which is listed above, right? I like to list the main assumption, the main drivers on top of the calculations, so you know exactly what assumption is being applied to our estimate. So that's the number of sales which will, or units sold, which will drive the revenues. And here you see I've included your average revenue per cell. And then I've also added a bit of what I call here a price increase index. So that's basically any inflation that you want to add on onto your average sales or average revenues. So for example, you will see that here you have an 85, it can be dollars or euros, or whichever currency you choose, average revenue per cell, which then increases to 87.1. Then to calculate revenues, what the model does, it just simply takes the number of your cells. So again, that's the driver that we've included at the very beginning. And then you multiply the number of cells times your average revenue, which then calculates the overall revenue. Okay, and that gives you the total revenue. And then the model goes into estimation of or forecast of the variable costs. So the variable cost, you can also think of them maybe as direct costs, of cost of sales. Those would be the costs that are directly linked to your sales, meaning that if your sales decrease or increase, those costs will also decrease or increase accordingly. And the I put two examples of the cost. So one would be a marketing cost per sale, or you can also think of that as an acquisition cost. So every sale will require an average spend, marketing spend, in order for that sale to occur. And then I also put other sales costs, which is just a percentage of the revenues that you receive. And now, based on those assumptions and then the drivers, which are the sales, you'll see that we can calculate your direct marketing costs, which will be just a multiplication of the average cost, the marketing cost per sale or average acquisition cost, which in our case here in this month is 30, and then the number of units sold, which in this case is almost 2.7 thousand. So you just take those two numbers, multiply by each other, and this gives you an estimate of your of the amount that you spend on marketing. And then also you have those other costs of sales, which are, in our case is just the percentage. So that's this 25% multiplied by revenues, again, which our case would be 220, almost 228,000. Okay, and that gives you that estimate of your cost of sales. Okay, so you have your revenues, you have your cost of sales, and that if you subtract one from the other, so if you take cost of sales and you subtract them from the revenues, you will arrive at your gross margin, and then you have your gross margin percentage. So that's the first sort of part of your cash flow model. Now let's move to our staff cost calculations and then general Opex. Okay, so in this model, I assume that you will have an X number of employees. In our case, it's 8. Each of these employees will have an average salary assumption. So in our case, that's, let's say, 4,000 per month. And then there will be some additional cost per employee, which I'll call just other costs. And based on these assumptions, you have the calculation of your salaries, which is just simply multiplication of your number of your employees times your average salary per employee. And then you also have the other staff costs, which again, the number of employees is still the driver, but then we're just using that other cost per employee number here to calculate this amount. And then that's just a sum of 38,000. You'll see that the costs, again, will, while the number of employees stay the same, the cost will increase a little bit on a yearly basis. Again, that's because I've included salary increase, so a bit of an inflation on the salary, which will kick in on the yearly basis. Now moving on, you also have the calculations of general Opex and things like office, other expenses, and some contingency. Okay, so those are just the fixed amount that I put in. So let's say we're going to spend 5,000, again, dollars or euros or pounds on office. Then there will be some other expenses, and then there will be some contingency. That figure again will increase on a yearly basis depending on the level of inflation that you put in in the model. Now, those figures here, so our gross margin, staff costs, and general Opex allows us to calculate the EBITDA. EBITDA being the earnings before interest, tax, depreciation, and amortization. And then again, you also have the EBITDA margin. Now, with those figures in mind, we can add some calculations of tax. So in this case, I assume 20% on tax. And then also I've added some capex. Then I've also have some working capital calculations, and then that will lead me to unlevered cash flow calculation, which is simply EBITDA minus the tax, minus the capex, capital expenditures, and then adjustments for your working capital. So that gives us the calculation of unlevered cash flow. So again, unlevered cash flow is any cash before debt injection. And then you will see that then the model proceeds to calculation of the debt drawn, principal repayments, and also interest paid and upfront fees. Now, this is something that will, at the moment, it's linked to debt model sheet. And then I will move on to this tab, this sheet, just to explain you how those numbers are derived. And then we'll come back to this sheet just to complete our cash flow forecast. And then also you'll see that below here, there's a bit more calculations of your depreciation and accounts payable and receivables. So those will be necessary to calculate the working capital. So let's move to debt modeling itself. And then again, we'll come back to this calculation, cash flow calculation here. Okay, let's have a look at the debt model. As you will see, I've started with linking some of the main numbers from the cash flow, like revenues, sales cost, gross margin, then also the Opex lines. Those would be the numbers that will be helpful when we determine the level of debt that will be forecasting in the model. Here I've listed the main assumptions. So, for example, term meaning the length of each of the debt that will take. In this case, for example, it's 72 months, which is 6 years. The interest only period 12. Frequency, so how often we'll draw a debt. Then the percentage of PV being the present value of debt. That's a figure that I will address soon, and it will allow us to moderate the level or adjust the level of debt drawn. And then the upfront fees, which is just a fee, one-off fee linked to any of the debt that is being drawn at a given time. Okay. Now, in terms of the structure of the model itself, you'll see that we'll start with the opening balance. Then we'll go into a debt drawn, which is the amount of debt that we want to add. Then there's a calculation of the remaining payments. That's something that we'll get to very soon. Your principal repayments. So let's just move to the right. So you'll see that that's where the calculation will kick in. And then the closing balance. So the closing balance is basically the opening balance plus the debt drawn, and then that amount is then adjusted for the principal repayment, and you end up with the closing balance. You'll see that I've split the debt also in tranches, just to give a little bit more, add a little bit more complication to the model. So you don't draw the debt, all the debt at once. It just assumes that you will draw the debt, let's say in this case, on an annual basis, okay? And then again, how much of the debt you can draw will be determined by the calculation, the formula that I'll get to very soon, right? And then, so you have your closing balance, for example, in January 24 is 4 million. And then you have interest payment calculations. Let's say in this case would be 27,000. The interest calculation is probably one of the easiest part of this model. It simply takes the debt, so the opening balance plus any debt that has been drawn, in a given month, and then it multiplies it by the interest, which in this case is 8%, and divides it by 12. You'll see that in most of the calculations that we'll do, the interest is divided by 12. The reason for that is that the 8 is the annual interest, and the model is done on a monthly basis. So in order to determine the level of monthly interest, you just divide the annual number by 12, 12 being number of months in a year. Okay, so that's why that happens, and then therefore you have that the interest expense, interest payment calculation, and then you also have the upfront fee, which is just simply the debt drawn number times that 1.5%. So that's again, it's just a one-off. It's just a fee that you will pay to for arranging the debt. Could be legal fees or bank fees or any other fees that you may encounter as the result of drawing the debt. Okay, so that's the structure. Okay, so let's go to the debt, the calculation of the debt drawn. In our case, what the model does, it determines the level of debt that you can draw based on the gross margin here. Okay, you'll see there's quite not a super long formula, but there's a few things in this formula that I'll get to. But one thing that you will see stand out is it just takes it looks at the gross margin from the last 3 months in order to determine the level of debt that you can draw. Some of the models, you may also find that you want to use EBITDA rather than gross margin, maybe revenues. I mean, again, it depends on the method that you want to use. You can adjust this formula accordingly. Okay. The idea of the formula itself, though, is to make sure that you can draw a debt to a certain level. So there's a limit to how much debt you can draw. And what the formula does, it just basically says the first part here, when you see the if statement, it simply just looks at the month at which you want to draw the debt. So for example, in this case, we want to draw first debt on month 13. And if that condition is met, it looks into the debt that can be drawn. So for that, the model uses the PV, which is a present value formula. And the way it works, it looks at the following few inputs. So first of all, the present value formula will take the rate, so that annual rate of 8%, and divide it by 12. Again, the reason for that is because we do everything on a monthly basis. Then it wants to look at the number of payments that we'll have in the for the debt. So that's again 72. That's the assumption that you can change as well. And then the payment that you will make. So that's the payment being the average gross margin from using the last 3 months. That's the average here. And then it will adjust that figure by that C21 assumption here. So that's 65%. And then it deducts that figure from when you see that P30, so that's the opening balance, it deducts that figure by the amount of debt that has been already drawn. The idea is that the level of your gross margin, in our case, will determine the maximum level of debt that a company can draw, right? So for example, in our case, we make around 100,000, just over 100,000 of a gross margin per month. This amount will determine the level of overall debt that the company can draw. This is then adjusted by that assumption here, 65%. So this is the overall level of debt that you can draw. If you have drawn already some debt, you need to then subtract that figure, and this will give you the incremental level of debt that you can draw. Okay. In our case, because we're in the first month of drawing a debt, there was no debt that had been already drawn. So the result of this calculation is that you can draw 4 million of debt. Okay. Then you will see, for example, in the year 2, you will move to the right. So we have another, we're drawing the debt in month 25. The calculation looks again at the gross margin. You see that the gross margin has increased, meaning that you can now draw more debt. In total, if I were to take out that, if I were just to take out that present value formula and nothing else, you will see that the output of this formula will be about 10 million, which means that the company itself can take on in total 10 million, just over 10 million of debt, because you have already drawn 4 million, or your balance sheet has a 4 million of debt. Therefore, your incremental level of debt that you can draw is 6 million. Okay, and now let's move to the calculation of principal repayments. So one thing that if we go back to the assumptions, you notice that there was an assumption around interest-only period, which is 12, which is set to 12 in our case. Again, this can be changed. It's just an assumption, flexible assumption, which allows you to have a bit of a break from when you draw the debt, which is here, to when you start making your first payment, okay, which will be that 55,000 in here. So if you look at the interest payment expenses, you start paying interest right away, but then you don't pay principal until later in time. And then the way the principal repayments work is we'll be using a PMT formula. So it's an Excel PMT formula. So we used before PV formula, which is a present value, and then PMT formula just allows you to calculate the payment amount that you need to put in order to repay the debt over a certain period of time. You will see that here, when we look at this formula, it basically says, okay, well, anytime the number of remaining payments is greater than 0, then use the PMT formula. And the PMT formula has a couple of inputs in here. First of all, you have a rate. So that's the your interest rate that we're using. It's 8%, again, divided by 12, because we want to go from an annual rate to a monthly rate. Then an NPER is the number of payments. So that's the number of payments that you have, number of remaining payments. And then the PV is the present value, is the value that you want to repay. So in our case, it's just going to be the opening balance of our debt number, right? So for example, in January 2025, we start repaying the debt. We have a 12-month principal repayment holiday. Your opening balance, so the amount of debt that you need to pay off is 4 million, just over 4 million. The number of remaining payments is 60. Therefore, and your interest rate annual is 8%, so 8 divided by 12 in the first input. The number of payments, so NPER, would be 60, and then the PV, which is in this case is the present value, but it's basically the amount of debt that you want to repay. That would be 4 million. Okay, and then it proceeds to next month, right? So that's again, it's using that 4 million as the amount, as the PV, so the amount of debt that you need to pay, and then the NPER is 59, because now you have 59 payments that you have to make, and so on and so forth, and so on and so forth, when it eventually goes to 0. Now, notice one thing only, that amount, which is a negative here, is then adjusted by the interest that you're paying. Okay, the PMT, what the PMT formula does, it calculates the entire payment that you need in order to service the debt. So the entire payment, meaning it's a combination of interest and the principal. Okay, and that's why you need to take in consideration the interest payment. So the entire payment would be, in our case, just over 80,000. That would be the payment that you make. But then of that amount, 27,000 goes towards the interest. And the interest is just basically, it's just a straightforward calculation, as we saw before. Is you take the debt that you open with, plus any debt that you've drawn in the given month, and then you multiply it by your interest expense, monthly interest expense. So that's why you have that 55,000. One way to check whether your calculation works is to see whether that closing balance, which is just simply addition of your opening balance plus your debt drawn and then adjustment for any principal repayment, whether that closing balance goes to a 0, right? There you go, goes to a 0 here, which means it seems to be working just fine. Okay, and you see that also you have a 1 payment here, and then it goes to a 0, which means you don't have anything left. Okay, now that formula is then, this calculation is then repeated for other tranches, and then you will see that your closing balance then, for example, consists of few tranches with different level of debt. Okay, so if we go back to our cash flow, monthly cash flow model, we'll see that all the figures here after the unlevered cash flow are then in that section for the levered cash flow are linked to our debt model in here, and then eventually that shows you the amount of levered cash flow in a given month, and then the cumulative levered cash flow will give you an idea of how much equity or how much cash do you need in order to fund the model itself. Now, if we go back to our summary, you'll see that that's just the annual aggregation of the numbers from our cash flow model. They're all linked here using that SUMIF formula. SUMIF formula allows you to aggregate the numbers by, in our case, by year. So that's your unlevered cash flow, and that's your levered cash flow here. And then, as I mentioned also before, here you can change any of the assumptions. So, for example, if you want to see how your numbers change based, for example, on change in your revenues, or let's say your interest per year, you can also use those numbers here. For example, let's look at the number here. So you see that this cumulative levered cash flow, that's the proxy for how much cash your business need after the debt injection. So in our case, we're saying that, okay, you still need almost 7.4 million in order to fund your business. So this is the amount of money that probably will come from, I mean, would probably come from equity. Let's change this interest to 12%. So you have a 7.4, and you'll see that, oh, wow, okay. So actually that increases quite heavily my cash need, right? So that allows you to run a sensitivity on the model itself to see, okay, how sensitive is my model to a certain inputs. For example, let's go back to our original, so 8%. Again, you see that 7.4 million is here as your cash need or your equity need. Let's see what happens if, for example, your marketing cost will go up. Okay, so remember we had that marketing cost which was done based on the number of sales and the cost per sale on the marketing cost per sale. So if I change that, for example, from 30 to 40, remember there was 7.4, and now you see, oh, wow, okay, suddenly almost doubles, right? So you see that's a very, very sensitive, very sensitive input, right? And so on and so forth. So you can just keep checking those numbers and then see, okay, what is the most sensitive input that I have in this model, and therefore you need to. It just allows you to find any weak spots in the model itself and potentially address any issues with your plan. Okay. Finally, let's go to equity return calculations, and then we'll very quickly go also to balance sheet just to see how those two calculations are linked to our cash flow. So the first part here, it just lists your main metrics from the cash flow model in order to determine the level of cash that you will need to invest, or equity that you will need to invest in the model itself. Okay, so this is just a summary of your cash flows from your cash flow sheet, or from your summary sheet, which is linked to a cash flow. So that tells you that first section Let me just make it a little bit bigger. That first section tells you, okay, what's my NPV or my IRR, which is return on investment, based on the cash flows before I insert any debt. The way those two calculations work, they are based on the, for example, if I double click here, on the figures here. So this is the level of cash or equity that you would need to put into the model, and that's the estimate of the amount of proceeds or cash that you would receive if you were to sell or do an IPO or any sort of exit for your company. And the way in this case the exit is calculated, the terminal value is calculated, is simply by taking the EBITDA, which is your which is your earnings before interest, tax, depreciation, amortization, and then just multiplies that by an multiplier, which in our case is 10. Now that number can be different depending on the industry. I use 10 just for simplicity, but you'll need to check what's the most appropriate value here. It also makes some adjustments for any cash that you may have in a company, and then it calculates the level of proceed that you will receive if you, for example, were to sell the company or maybe list the company. Okay, so that figure here allows you then to calculate the IRR, which is just simply the returns based on the amount of cash or equity invested into the business, and then the level of proceed that you can expect to receive on exit. Then I've added a few cash flow lines. So I divided the cash flow lines into cash flow from operations, from investing, then also added the debt financing, any sort of amount related to debt service, some tax adjustments. The model does allow you to choose whether you want to make your interest expenses tax deductible, for example. So that's why you have that tax adjustment here. This will gives you the level cash flow, which is the cash flow that you will find also in the cash flow model sheet or in the summary. And then you have a bit of a calculation here. Okay, well, based on my level of debt that I can draw and also the cash that I have or any surplus that I generate, then that's the amount of equity that I need to add into the business, right? So you will see that while in the first year, for example, you need exactly the same equity as you would need if you were to just look at the unlevered cash flow, so any cash before the debt. But then in 2024, you start adding debt, and a lot of that cash requirement from here is then covered by your debt. Your equity need is 7.4 million, which is much lower than the 70 million if you were not to add any debt. And then again, based on those new figures, you can calculate the exit proceeds, which will be calculated in the same way in this case as in case of the unlevered cash flows. So you take the EBITDA and multiply it by in our case 10 or any other figure that's relevant. Then you make the adjustments to any closing cash. This will be a bit different because you have some debt repayment and debt servicing as well. And then you also may have to repay some of the debt that you still have on your books when the exit occurs, and that gives you the amount of money that you will receive. So you see that's lower than in the case of unlevered cash, but then your equity investment was also lower. That then takes you to your return calculation, which is just exactly the same calculation that we used above, but now it just uses the figures from the levered cash. And lastly, I've also added some more summaries here. So for example, you have your owner's equity calculation, which is part of the balance sheet, which I'll address shortly. You have your cost of capital calculation. So that just assumes that it just calculates the weighted cost of capital, which is a blend between the level of equity that you have in the company and the debt itself. And then it also just shows the total funding. So that allows you to create a graph that shows the level of total funding by source. And you will see that the ratio of debt to equity is changing quite heavily over time, being skewed towards the debt. As we saw from the cash flow, your company is generating more and more revenues, which can be used to inject more debt in the future. Let's go to a balance sheet. That's a very quick, simple summary of all your assets and liabilities. So you'll see that most of these items here are connected to your cash flow calculations. So any change that you make in the model on your cash flow forecast will be reflected in your balance sheet. So you have level of cash that you will have in your company, receivables, capex or capitalized R&D. Now, one thing to note is that when you look at this model, you see that there's a development and R&D line. Now, this may it depends on the accounting rules that you apply. You may have to put some of the R&D or all of the R&D or development into expenses, or maybe you can split them between your operating expenses and capital expenditure. It's something that's always worth double checking depending on what rules you apply to the model. Again, this is just a simple simulation to show you, okay, if you were to have any capital expenditures, this is how you can link them to your balance sheet. That's your incremental capex, which is then adjusted for depreciation to calculate your long-term assets. On the liability side, you have accounts payable, you have short-term debt, which is the debt that you need to repay within a year. And then you have a long-term debt, which is just the remainder of the debt. So basically your debt closing balance minus any short-term debt. You'll see that links to that calculation links to your debt model, which we covered previously. And then owner investments, that links to calculation of your equity injections from that equity return sheet. Then you also have some retained earnings, which links to our cash flow calculations here. So I've added some additional lines below that lever cash flow that allows you to calculate your depreciation and earnings, taxes and those accounts receivable and working capital. And then you end up with your total liabilities and owner's equity. And as ever, it's very important to make sure that your assets equal to your liabilities and owner's equity. That's why I added a check here, just in case if there is any discrepancies, you should see that check will highlight the difference between the two. And then finally, just for the debt summary itself, I've also summarized the debt model. So you will see that you have your opening balance, the debt drawn, and principal repayments, which are taken from the debt model that we covered. That allows you to calculate some of the metrics, for example, like debt to EBITDA, which is one of the metrics that's is used to determine whether you're drawing too much debt. And then also you have a calculation of your principal repayments, interest, and upfront fees, which allows you to calculate the level of debt service, and that allows you to calculate the DSCR, which is the debt service cover ratio. It's a metric that tells you whether the company is able to service the debt. In this case, is using EBITDA for in this calculation. Again, with the idea that if the figure is below 1, it means that the company may struggle. It's not generating enough earnings to cover the debt. And then lastly, you have the debt to equity, which is a calculation that takes the debt balance figure and then it divides it by the total equity.
I hope you enjoyed this tutorial. If you'd like to find out more about financial modeling, or if you want to download the template used, follow the link which you will find in the description of this video. Thank you very much.